Something extraordinary is unfolding in the precious metals market today, and the magnitude of these movements is impossible to ignore. Within just a few hours, silver spiked 9%, while gold smashed through the $5,100 level, sending shockwaves across global financial markets. These are not ordinary price shifts or minor fluctuations. This is a full-blown volatility explosion, a signal that the market is entering one of the most critical phases since the 2008 financial collapse. Anyone watching closely knows this is more than a routine rally. It is a systemic warning. Gold and silver have always been more than commodities. They are barometers of confidence. They measure trust in fiat currencies, stability in financial systems, and the underlying strength of global economies. When uncertainty rises, capital naturally seeks safe havens, and there is no clearer shelter than these two precious metals. Today's rapid movements underscore exactly that principle. Investors are fleeing risk, and the market is reacting with intensity rarely seen outside major financial crises. The surge in silver, 9% in mere hours, is remarkable. Historically, moves of this magnitude occur only during periods of extreme tension, whether geopolitical, economic, or systemic. This level of movement indicates that both retail and institutional investors are aggressively repositioning themselves. The action is not impulsive or emotional, it is deliberate. Every spike, every surge is a reaction to underlying market stress and strategic accumulation by those with foresight and significant capital. Meanwhile, gold breaking the $5,100 barrier is equally significant. Price thresholds like this are psychologically and structurally critical. They signal demand dominance, revealing that buyers are willing to step in even at historically high levels. When gold rises this way, it is not simply a price movement. It is a statement about the underlying health of the global monetary system. Investors are clearly hedging against instability, recognizing that traditional assets are under pressure. A key driver behind these explosive moves is the structure of the precious metals markets themselves. Gold and silver are heavily traded on futures markets, which operate with significant leverage. Large positions controlled with relatively small amounts of capital amplify gains and losses alike. When prices move aggressively, leveraged positions are forced to adjust. These adjustments cascade through the market, creating momentum that can propel prices far beyond what fundamentals alone would suggest. Short covering is another contributing factor. As silver surged, traders holding short positions were forced to exit to avoid mounting losses. This action itself generates more buying pressure, which drives prices even higher, creating a feedback loop of accelerating momentum. Such conditions often lead to sudden spikes in prices, exactly what we are witnessing now. Institutional capital plays a monumental role in shaping these moves. When hedge funds, banks, and large investors increase their allocations to silver or gold, the market responds dramatically. Unlike equities, silver markets are relatively small. This means even modest inflows from institutional investors can trigger explosive price action, amplifying volatility beyond the expectations of most retail participants. Global economic uncertainty is fueling the fire. Inflation remains a central concern for investors worldwide. Even if official reports indicate moderation, years of monetary expansion continue to erode purchasing power. Holding cash or bonds exposes investors to the silent threat of currency devaluation. In contrast, gold and silver provide tangible protection, offering security in times of uncertainty. Geopolitical tensions further exacerbate market volatility. Recent developments between major global powers have heightened risk perception, pushing investors towards safe haven assets. Gold and silver, historically reliable during periods of conflict, are benefiting from this rush. The speed and magnitude of today's moves reflect not just local concerns, but global anxiety about systemic stability. Liquidity, or the ease of buying and selling assets without affecting prices, is another crucial factor. When liquidity is plentiful, markets remain stable, but as liquidity tightens, even small inflows or outflows of capital can generate outsized price movements. The 9% spike in silver demonstrates that liquidity is being tested, and that markets are now sensitive to both large and small trades. Investor psychology cannot be overlooked. Markets are influenced as much by perception as by fundamentals. Fear, anticipation, and uncertainty drive behavior. When investors sense instability, they move aggressively into safe haven assets. These shifts are amplified by social signals and news coverage, creating self-reinforcing momentum that propels prices even higher. Silver's volatility is amplified by its dual nature. Unlike gold, silver serves as both a monetary and industrial metal. It is essential in electronics, solar panels, and advanced technology. Industrial demand provides a baseline of support, while monetary demand reacts sharply to uncertainty. When both forces converge, as they are now, explosive movements are inevitable. Supply constraints add another layer of pressure. Silver mining cannot scale up instantly. Developing new production requires years of investment, regulatory approvals, and infrastructure. This supply inelasticity means that any surge in demand produces dramatic price effects, as buyers compete for a finite physical supply. Central bank actions are also shaping the market. Many nations have been increasing gold reserves aggressively in recent years, seeking to reduce reliance on fiat currencies and strengthen financial independence. This accumulation creates a structural floor under gold prices and reinforces the long-term trend toward higher valuations. The interaction between futures markets, retail participation, institutional capital, and central bank buying creates complex dynamics. While short-term volatility may appear chaotic, it is grounded in strategic repositioning and structural forces. Today's 9% silver spike and gold's breakout are not random. They are the visible signs of deeper systemic shifts. Historically, similar movements have preceded major market transitions. The 2008 financial crisis, the post-quantitative easing shifts, and earlier monetary upheavals all demonstrated that precious metals react first to systemic stress, often before other asset classes. Today's action suggests we may be witnessing the early stages of such a transition. Technological changes intensify volatility. Algorithmic and high-frequency trading respond instantly to price shifts. When certain thresholds are breached, automated systems execute trades that amplify market movements. This is one reason why today's moves occurred in a compressed time frame. Retail investors are increasingly active in precious metals. With access to digital trading platforms, individual participants can now enter markets previously dominated by institutions. This democratization increases emotional volatility, as retail traders react quickly to news and price movements, reinforcing the trend. Debt levels and monetary policy continue to shape market perception. Governments globally face historically high debt burdens, making traditional fiscal tools less effective. Low real interest rates encourage investment in assets that preserve value, like gold and silver. This environment supports long-term strength even amid short-term swings. Volatility, while risky, also signals opportunity. Investors who understand these dynamics can position themselves strategically. Short-term spikes, such as today's 9% surge in silver, may appear intimidating, but they often precede sustained trends in the direction of structural demand. Understanding the difference between short-term noise and long-term trends is essential. Volatility represents the market adjusting to new realities. It transfers assets from weaker hands to stronger hands, consolidating positions in preparation for the next major movement. Gold and silver, by design, are the instruments through which these shifts are most visible. Financial transitions are rarely smooth. They involve bursts of instability, sharp price swings, and periods of heightened uncertainty. Today's moves are consistent with this pattern. The current environment is one where both strategic investors and opportunistic traders must exercise awareness and discipline. The interplay of geopolitical risk, inflation, currency pressure, central bank behavior, and industrial demand has created a perfect storm for precious metals. Gold acts as the ultimate hedge, while silver amplifies the movements due to its dual industrial and monetary roles. The convergence of these forces explains the unprecedented pace of today's gains. Looking forward, analysts are watching key levels. Gold may continue toward $5,200, $5,400 if momentum persists, while silver could test $9,100 in the short term. Extreme scenarios driven by structural shifts could push gold toward $5,800 and silver toward $120. These are not just speculative projections. They reflect underlying market realities. Smart money is positioning aggressively. Institutions, hedge funds, and high-net-worth investors are reallocating assets toward precious metals. They understand that volatility today is a precursor to structural gains tomorrow. Retail investors who follow these signals can benefit from early positioning. Every surge and breakout today is a market signal. The 9% spike in silver is more than a headline. It is a message about market confidence, liquidity stress, and risk perception. Gold's breakout past $5,100 confirms that systemic demand is supporting the move. Volatility also educates the market. It weeds out weak hands, consolidates positions, and transfers control to participants with conviction. These phases historically precede larger, sustained upward trends in precious metals. The combination of systemic stress, market psychology, leverage, liquidity constraints, industrial demand, central bank accumulation, and geopolitical tension make today's market environment unique. Few periods in modern history have combined these forces with such intensity. Investors who understand the underlying dynamics see today's spike not as a temporary anomaly, but as a signal of structural realignment in global finance. Gold and silver are reflecting the shifting balance of power, the fragility of fiat systems, and the growing importance of tangible safe haven assets. This is a moment for awareness. Markets are moving rapidly. Positions must be chosen carefully. Understanding the forces at play provides insight into the path ahead. History shows that periods of high volatility in precious metals often precede monumental financial shifts. Today's 9% silver spike and gold breakout above $5,100 are more than price points. They are signals from the market itself. They indicate volatility, systemic stress, and the growing prominence of safe haven assets in a world increasingly uncertain about currency stability, debt sustainability, and geopolitical risk. For investors, the message is clear. Volatility is not the enemy. It is a guide. It reveals opportunity, highlights risk, and signals where capital should be positioned. Silver and gold are leading indicators of broader economic conditions, and today they are speaking louder than ever. The next hours, days, and weeks will determine whether these moves stabilize or accelerate further. But the underlying forces driving today's unprecedented activity, fear, demand, structural stress, and strategic repositioning, remain intact. Precious metals are the safest lens through which to observe the early signs of a potentially historic financial transition. In conclusion, today's events mark a pivotal moment. Silver's 9% surge and gold's breakout above $5,100 are clear, undeniable signals of extreme volatility and systemic adjustment. Understanding these movements, their causes, and their potential consequences is essential for any investor navigating today's turbulent markets. This is not just a market update. It is a wake-up call. Precious metals are telling us the story that no headline can fully capture. And for those who are paying attention, the path forward is both clear and urgent. Volatility is here, structural change is underway, and the time to observe and act is now.